Hello and welcome to the first ever XP Actuarial webinar series. I first want to thank all of you tuning in to watch this live, and as a friendly reminder, the webinar will be available to watch off air after the webinar is complete. If your screen is blurry, please change the display settings to 720p, and you can do that in the bottom right hand corner. There is a settings button. Click that and select 720p. As part of a thank you for watching the live webinar, all viewers will receive a free practice question set that contains 100 practice questions for this exam. My name is Clayton Zalewski and I will be leading you through this webinar. The webinar will walk you through Objective 1 to 5 and cover the most important concepts on the exam. If you missed something or want to rewatch the webinar, it will be posted on our website, www.xpactuarial.com, shortly after the webinar ends. So without further ado, let's get started. So the webinar is split into objectives, and each objective covers a certain amount of readings. Objective 1 covers ERM 102.12, 105.12, Financial Enterprise Risk Management Chapter 9, and Value at Risk Chapter 8. The first topic we will cover is environmental scanning. This is something that you should memorize, and it consists of tools used to aid you with strategic decisions and to gather information to help you along the way. The first two techniques are formal search and conditional viewing. With a formal search, you obtain information in a very structured manner. The information is relevant to specific issues and will be used for planning or decision making. Conditional viewing occurs when you track pre-selected information from a particular source. It is aimed at identifying evolving issues. The next two are informal search and undirected viewing. With an informal search, you look through information in an unstructured manner. The aim is to increase your understanding of developments and identify anything that might require action or attention. Undirected viewing consists of scanning many different sources of information without any specific need in mind. It helps to sense new trends and develops unconventional thinking. The next important topic from this objective is the Porter 5 Forces model. This is a classic management model that is taught in many business schools. There are 5 forces, which are the threat of new entrants, bargaining power of buyers, bargaining power of suppliers, threat of substitute products or services, and the intensity of competition in the industry. A typical exam question would ask you to apply the Porter 5 Forces model to a company, and you'll have to think on your feet. Something that I would suggest is to practice using the Porter 5 Forces model with different industry examples of companies, such as, say, Apple, GM, and so on. Next up, we have SWOT analysis, which consists of strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are internal to the organization, whereas opportunities and threats are external. So a typical question will ask you to perform a SWOT analysis on a company, and you will need to again think on your feet here and list out strengths and weaknesses, remembering to keep those internal to the company, and opportunities and threats, again keeping these externally focused. Next up, we have the risk map. So first, we want to rank the frequency of a risk, and we give risks a ranking between 1 and 5, or 1 and 6. 1 would represent a rare risk, and 6 would represent a frequent risk. Next, we map the severity of the risk. 1, again, would map a minor risk, and 6 would map a catastrophic risk. The next step is to map these on a chart, with likelihood on the x-axis and impact or severity on the y-axis. And the risks that we want to focus on first are in this upper right-hand corner. Once these risks are addressed, we would then move down to the next level, and then slowly making our way down to the bottom over here. Next, we'll go over the influence matrix. What we first do is label all our risks on a grid. So for example, suppose we have 6 risks. We would label risk 1 through 6 on the rows and 1 through 6 on the columns. The influence matrix allows us to examine the interdependencies between our risks, and we assign a score based on the level of impact one risk has on another risk. A score of 0 would be for no or an insignificant impact. 1 for some impact and 2 for a high impact. Then we would total the rows and the columns. The total of the rows over here would help us determine the ranking of each risk in terms of importance. The totals of the columns allow us to understand how each risk factor is being influenced by the other risk factors, and this is often called a passive score. So risks with high passive scores, such as risk 2 and 3 here, are highly influenced by the other risks. So what are the two primary goals of ERM? The first is to identify, evaluate, and quantify the risks of an organization. The second is to implement strategies that achieve the desired risk-return trade-offs that management wants. Another important definition from this objective is ORSA. ORSA stands for the Own Risk and Solvency Assessment, and the ORSA is an iterative process of identifying and evaluating risks, setting strategy, and monitoring the results of an insurance company, and it is part of the overall ERM program. Next up, we have a fairly important concept for ERM, which is the ERM framework. In the middle of the diagram here, we have the core components, which are culture, organization, governance, internal controls, policies, and procedures of the company. These are the core components to an ERM framework. Next, we have the ERM control cycle of identifying, evaluating, setting strategy, and monitoring results. Outside of this, we have the external components, like the marketplace, economy, rating agencies, regulators, investment community, and external audit. All of these components make up the ERM framework. Next, we have two common risk measures used on the exam. The first is the value at risk, which is the maximum loss X, such that the probability that the loss exceeds X in a given time frame is no more than 1 minus alpha, where alpha is our confidence level, and VAR can be thought of as a quantile. Tail value at risk is the expected amount of loss in the worst 1 minus alpha % of the distribution, and we also call it the conditional tail expectation, CTE, or worst tail or conditional expectation. So suppose we have a distribution, and we select a point right here, 1 minus alpha. This point on the distribution right here is our VAR. The tail VAR is the average of the values past VAR. We'll cover these later on in the video. Next up, we have risk-adjusted performance measures. And the first of them is the risk-adjusted return on capital, or RAROC. And that is equal to risk-adjusted net income divided by allocated economic capital. The second is the return on risk-adjusted capital, or ROROC, which is equal to net income over allocated economic capital. You'll want to memorize these because it's likely that they'll give you the risk-adjusted net income and ask you to calculate the RAROC and ROROC for different companies. Moving on, we'll cover credit risk. Credit risk here refers to default risk, and it's often the largest risk for banks. Another slightly related component is counterparty risk for financial trades or derivative trades. And this is the risk that the other party in a derivative transaction cannot make his or her payments, resulting in a loss. Credit risk is very similar to non-life insurance risk, or the stuff that you studied on exam C. So there's an incidence rate or a probability of default, and an intensity or a severity, which is related to the recovery rate. Market risk and economic risk are also linked to credit risk, so it's important to consider credit risk with the interaction between market and economic risk. Three important concepts are the adverse selection, moral hazard, and agency risk. Adverse selection is the risk that the demand for insurance is positively correlated with the risk of loss. Think about unhealthy people that might have a higher chance of dying in the next year or two, going out and finding or trying to purchase insurance. Moral hazard is the risk that behavior will change once insurance is in place. Think about you buying a life insurance policy and then the next day going skydiving and deep sea fishing. Agency risk is the risk that one party, appointed to act on behalf of another, will instead act on its own behalf. This is the classical manager versus shareholder dilemma. The manager is appointed to act on behalf of the shareholders, but at the same time, maybe they want a company car or some perks along the way. This is known as agency risk. Next, we'll cover liquidity risk, and there are two types of liquidity risk. Market liquidity risk, which is the risk that a firm cannot easily trade due to a lack of market depth or due to market disruption, and funding liquidity risk, which is the risk that a firm cannot meet expected or unexpected current or future cash flow needs. Another component of liquidity risk that's important are bid-ask spreads. The mid price is the average of the bid and ask quote. The bid-ask spread is the difference between the bid and ask prices. And our spread is equal to P-ask, or our ask price, minus our bid price, divided by our mid price. Now, an easy way to remember this is that the ask is the price that we buy at, and the bid is the price that we sell at. And the way that I remember that is that bid does not equal buy. So B and B. So bid does not equal buy. Bid must then equal sell. And that means that ask must equal buy. So if you want to buy a stock, you'll have to pay the ask price. And if you want to sell a stock, you'll have to pay the bid price. Next, we'll cover liquidity adjusted VAR, LVAR1 and LVAR2. So if spreads are fixed, the liquidity adjusted VAR is our traditional VAR, or VAR, plus an extra term. And depending on liquidity adjusted VAR 1 or 2 depends what our formula for L1 or L2 will be. With L1, it's equal to 1/2 times W times S, where W is our wealth of our portfolio and S is the spread. If we want to introduce uncertainty into the spread, we get LVAR2. So we model the mean of the spread as S bar and the standard deviation as sigma S. And then the worst increase in the spread at some confidence level is modeled. So our L2 term would be 1/2 multiplied by W, but instead of multiplying by S, we multiply by S bar plus alpha times sigma S, where alpha is at some confidence level. So we'll go over an example. Suppose we have 1 million invested in a stock with daily volatility of 1% and spread of 0.002. Calculate the one-day LVAR at the 95% confidence level. So our LVAR would be equal to W, our wealth, or 1 million, multiplied by alpha. In this case, it's a 95% confidence level, so 1.645, multiplied by sigma, 0.01. Plus 0.5, again, multiplied by W, 1 million, multiplied by S, our spread, 0.002. And that gives us 17,450. Now assume that the 99% LVAR2 is equal to 775,600 for a 1 million position. You're also told that the average spread is 6%, the volatility of the position price, so note position price and not volatility of the spread, is equal to 30%. And then we're asked, what is the standard deviation of the spread? So this is a simple algebra problem. So we have LVAR2 is 775,600, and that's equal to 1 million W multiplied by alpha. In this case, we have a 99% confidence level, so we'll select 2.33. Then we'll select our sigma of our position price, which is 0.3. Then we have 1/2 multiplied by, again, a million, multiplied by our S bar. And in this case, S bar is our average spread, so 0.06. And we'll assume that alpha, again, is 99%. And then we have sigma S. So then all we need to do is rearrange and solve for sigma S. And we get sigma S equal to 0.04. Another concept we'll cover is immediate versus uniform liquidation. With immediate liquidation, we liquidate the entire position today. With uniform liquidation, we liquidate it over n days. And this creates a different price drop in the share price of the stock, as well as a price impact to our portfolio. The price drop with immediate liquidation is P0 times K times Q. Now, P0 is our price per share, K is known as a market impact factor, and Q is the number of shares. With with uniform liquidation, the price drop is P0 times K times Q, but this time divided by N, our number of days that we're liquidating over. So we'll go over an example. Assume that the current price is 100. Our market impact factor is 0.5 times 10 to the negative 7, and we have 1 million shares of stock. If we liquidate all at once, what is the expected price drop and total price impact? If we instead decide to liquidate 200,000 shares over 5 days, what is the price drop and total price impact? So our price drop here would be P0KQ. So P0 is 100, K is 0.5 times 10 to the negative 7, and Q is 1 million shares. And that gives us a value of $5. And the price impact would be K, 0.5 times 10 to the negative 7, multiplied by Q squared, so 1 million squared, multiplied by P0 here, so 100. And that gives us 5 million. So the price drop in the market would be $5, and the price impact would be 5 million. If we have uniform liquidation, the price drop would be P0, 100, multiplied by K, multiplied by our number of shares, 1 million, divided by the number of days, 5. And this is $1. And the price impact would be 0.5 times 10 to the negative 7, multiplied by our number of shares squared, divided by 5 days, multiplied by 100, our price per share. And that gives us 1 million. So with uniform liquidation, our price impact is only 1 million versus 5 million with immediate liquidation. So why wouldn't we just always liquidate over a uniform horizon? Well, we also have price risk. So we introduce a second component, VW, called price risk. And this is the risk that price will change over the period of time that we're liquidating over. So if we immediately liquidate our position, the price risk is 0 because we've already liquidated our position. If we want to uniformly liquidate our position, we have to calculate the price risk. And the formula for price risk, V2W, is sigma squared Q squared multiplied by this factor here, which we'll call T star, multiplied by P0 squared. So putting these two things together, we get a formula for LVAR. So our LVAR is equal to alpha, which is our confidence level, multiplied by the square root of our price risk, plus our price impact function. So if we have uniform liquidation, this VW term is 0. So our LVAR is just equal to K times Q squared P0. If we have immediate this should be the formula for immediate, and this should be the formula for uniform. With uniform liquidation, the formula is alpha times the square root of sigma squared Q squared T star P0 squared plus our price impact function of K times Q squared over N P0. So let's go over an example. Calculate the 99% liquidity adjusted VAR for 50,000 shares trading at $30 per share with daily price volatility of 2%. Assume uniform liquidation over 10 days and that the market impact factor again is 0.5 times 10 to the negative 7. So our LVAR is equal to, with 99% confidence level, is 2.33 times the square root of VW plus CW. So it's equal to 2.33 multiplied by our VW term. Now what we need for VW is our T star value. So T star with 10 days would be 10 times 1 over 3 multiplied by 1 minus 1 over 10 multiplied by 1 minus 1 over 2 times 10. And this gives us 2.85. So going back to our LVAR would be 2.33 times the square root of 0.02 squared multiplied by the number of shares, 50,000 squared, multiplied by T star, 2.85, multiplied by P0 squared, 30 squared. Then we're going to add our other terms. So we have 0.5 times 10 to the negative 7 multiplied by our number of shares squared divided by 10 days multiplied by our price per share of 30. And this gives us 118,379.78. So now we'll move on to Objective 2 readings. And the readings we'll cover are Value at Risk, Chapter 5, 7, 9, and 12, Financial Enterprise Risk Management, Chapter 12 and 14, ERM 101.12, 106.12, Summary of the Variance of the CTE Estimator, and ERM 125.15. We'll start with Value at Risk. Value at risk is the worst loss over a target horizon such that there is a low prescribed probability that the actual loss will be larger. Again, think back to before. It's a quantile in a loss distribution. And we need to specify the horizon. Here we're talking about time horizon and the confidence level. And the VAR is then the smallest loss such that probability of L is greater than VAR is less than 1 minus our confidence level C. We can then define relative VAR and absolute VAR. Relative VAR is defined as the dollar loss relative to the mean on the horizon, and absolute VAR is the dollar loss relative to zero, or without reference to the expected value. So relative VAR is the expected value of W minus W star, our quantile value. And absolute VAR is W0, which is often just 0, minus W star. So if we wanted to think of this on a distribution, suppose we had a distribution like this, and this is our VAR term here. Assume that right here is 0, and right here is our expected value. The relative VAR would be the difference or the distance between these 2 points, and the absolute VAR would be the distance between these 2 points. So if our expected value is greater than 0, the relative VAR will always be greater than the absolute VAR. A trick question might be that if they give you an expected value that's less than 0 here, then the relative VAR is actually going to be less than absolute VAR. Just a side point on the exam. Parametric VAR, we can then define relative and absolute VAR with a parametric distribution. The relative VAR would be W0 multiplied by alpha sigma root T. Again, here we're measuring from the mean, and the absolute VAR where we're measuring from 0. So it's equal to W0 multiplied by alpha sigma root T minus mu root, or mu times T. Next, we'll cover portfolio VAR. So we let sigma be the covariance matrix between n assets. And then the portfolio variance, or sigma p squared, is equal to W prime sigma W, where W is our portfolio weights. So what is the weight of each of the n assets? And sigma is our covariance matrix with variance terms down the diagonal and covariance matrix or covariance terms along the off-diagonal terms. So then we can also write this in terms of dollar exposures or in terms of dollar amounts. And we just take the portfolio variance, multiply it by our portfolio amount squared. And that gives us the matrix x prime sigma x. And then finally, the portfolio VAR is then alpha times sigma pw. And we know that sigma p squared w squared is equal to this. So we can show that portfolio VAR is equal to alpha times the square root of x prime sigma x. Next, we'll cover diversified VAR, undiversified VAR, and individual VAR. Diversified VAR is the portfolio VAR taking into account diversification between the components. Undiversified VAR is just the sum of the individual VARs. The diversification benefit is the difference between the diversified VAR and the undiversified VAR. And then finally, individual VAR is just our formula from before. It's just alpha sigma times, here, Wi times W would be equal to Xi. So we have an example. You are given the following portfolio of 3 assets. Using the covariance matrix below, calculate the 95% VAR. So VAR would be equal to 1.645 multiplied by the square root of our portfolio variance, which would be our x terms multiplied by our covariance matrix. And I'll just save myself from writing all these terms out. Multiplied by our x matrix transposed here. Now, simple matrix algebra, we would take this term here, this term here, and we'll multiply it by the first column, and we'll take it, multiply it by the second column, and multiply it by the third column. That will give us a 1 by 3 matrix multiplied by this matrix here, and then we just multiply this over here, and what we get is a result for the answer would be 104.7259. Marginal VAR is the change in portfolio VAR resulting from taking an additional dollar of exposure to a given component. It's also the partial derivative with respect to the component position. And it is closely related to the beta of our portfolio, where beta is equal to sigma W over W prime sigma W. And the relationship between marginal VAR and beta, marginal VAR I is equal to our total VAR divided by our position size or our portfolio size, multiplied by the individual beta I. So find the 95% marginal VARs for the following portfolio. So we want to calculate our marginal VARs. That would be equal to alpha sigma W over the square root of W prime sigma W. So that's equal to 1.645 multiplied by our sigma matrix multiplied by our W. And then we're going to divide that by the square root of our W's multiplied by our sigma matrix multiplied by our W. And that's going to give us a 2 by 1 matrix of marginal VARs. So our first marginal VAR would be 1.838295, and our second marginal VAR is 1.697686. Next up, we have incremental VAR. Incremental VAR is the change in VAR owing to a new position. It differs from the marginal VAR in that the amount added or subtracted can be large. So marginal VAR works with small changes. Incremental VAR can also work with large changes. It's used to evaluate the impact on VAR from a new position. So the first principles approach to incremental VAR is to calculate the VAR of the portfolio with the new position minus the VAR of the portfolio without that new position. The problem with this approach is it requires you to recalculate, in some cases, entire simulation models, and this can take a very long time and a lot of computing resources. Luckily, there's an approximation. So the incremental VAR is approximately equal to the marginal VAR times the matrix of our A position, so our new position A. And an easy way to describe that is with an example. So assume we have two marginal VARs for two stocks of 0.0528 and 0.1521. Suppose we want to add 10,000 to our first position, and we want to calculate the incremental VAR. So we can approximate it by taking our marginal VARs multiplied by our matrix A of our new positions. So our marginal VARs are listed here, and then our new position would be 10,000 of the first stock and 0 of the second stock. We just multiply these two matrices, and we get 528 as our incremental VAR. Next, we have component VAR. Component VAR is a partition of the portfolio VAR that indicates how much the portfolio VAR would change approximately if the given component was deleted. And by construction, the component VARs actually sum up to the portfolio VAR. And our formula for component VAR is equal to marginal VAR multiplied by our position size xi. And the component VAR again indicates how much the VAR would change approximately if the component was deleted. And a nice thing about component VAR is that the sum of the component VARs, VAR1 to VARn, is equal to our total VAR. Because that's the case, we can also calculate the percentage contribution of each CVAR to the total VAR. And here we just take the CVAR for position I divided by our total VAR. An easy way to explain that is with an example. So suppose we have the marginal VARs for two stocks as before, and the position size of the first stock is 2 million and the position size of the second stock is 1 million. We want to calculate the component VARs and the percentage contribution to total VAR. And we're told that the total VAR is 257,738. So our CVAR is just calculated by taking the marginal VAR multiplied by the position size. So our CVAR1 is just 0.052 times 2 million, and CVAR 2 is 0.1521 times 1 million. And we get 105,630 and 152,108. If you take the sum of these two, it'll add up to our total VAR. And then to calculate the percentage component or percentage contribution of CVAR 1 to total VAR, we just take CVAR 1 divided by VAR and CVAR 2 divided by VAR. This is pretty simple. Now we'll move on to moving average, and with this we're talking about volatility. Moving averages are a simple method that is widely used, and it utilizes a moving window of fixed length for estimating the volatility. Some examples are 20 days, 60 days, and so on. And the formula is our variance estimate is equal to 1 over m times the sum of our returns squared over m days. Now we focus on raw returns here, not r minus mu, because we're dealing with short time periods, and it is often assumed that the mu, or the mean, over short time periods is 0. So each day we add new information for that day and drop information from m+1 days ago, and all weights in this model for each data point are the same, equal to 1 over m. So what are some drawbacks to this? Well, it ignores the dynamic ordering of positions, so recent information receives the same weight as older observations that may no longer be relevant. It also introduces a ghosting feature. And this occurs when large historical returns, think of the financial crisis, large negative returns, or what followed after that, large positive returns. Now, as they drop out of the measurement period, the volatility will appear to suddenly drop or increase for no apparent reason. And another drawback is that we can avoid this with longer periods, but with longer periods, it increases the precision of the estimate, but it misses out on the underlying variation in the volatility that occurs over shorter time horizons. So to counter this, we have the Garch 1-1 process, which our volatility estimate HT is equal to alpha 0 plus alpha 1 times RT minus 1 squared plus beta times our previous day's volatility estimate. Now, something to note is that for the model to be stationary, we need A1 plus beta to be less than 1, and this is referred to as persistence. And the reason I put that in this video is that a typical question would be define persistence or show that the model is stationary. And all you would need to do is grab the alpha 1 parameter and beta parameter and show that it's less than 1, and then your model is stationary. So what are the drawbacks? Well, this model is nonlinear, and the parameters must be estimated using maximum likelihood, which often involves optimization. And a more technical thing is that usually these scaled residuals have a normal distribution and are independent. Now, obviously, the normal distribution doesn't always apply to reality, and therefore, this model may not actually be a good fit for reality and stock prices, for example. So we'll go over an example. Assume that the current estimate of volatility is 25%, and you're told that returns over the next 3 days are as follows. And you're given a Garch 1-1 estimate of volatility. So we can show 0.3 plus 0.4 is 0.7 is less than 1. So this process is stationary. Now we know that H0 from above is 0.025, and we know that R0 is 0.2. So H1 would be 0.2 plus 0.3 multiplied by R0, the previous day return, squared, plus 0.4 times H0, which is 0.25. And that gives us 0.312. Then we can estimate the next day. So we take alpha 0 plus 0.3 multiplied by our new return value, 0.15 squared, plus 0.4, our beta value, multiplied by our 0.312, and that gives us 0.33155. And then we can repeat that for the remaining estimates. Next, we have the exponentially weighted moving average, or UMA model. The forecast for time t is a weighted average of the previous day forecast and the latest squared innovation, or latest return. And the weight of the previous factor is lambda, where lambda is the decay factor. So our variance estimate is equal to lambda times the previous day estimate plus 1 minus lambda times our return from the previous day squared. We can also develop a recursive formula for this, which is quite handy. So again, we have an example. We'll assume the current estimate of volatility is 25%, and you're told that the returns over the next 3 days are as follows. And we're also told that lambda is equal to 0.8. So we know that H0 is 0.25. From above, H1 would be 0.8 multiplied by our previous day estimate of 0.25 plus 0.2 multiplied by our previous day estimate or return squared. And that gives us a value of 0.208. And H2 then would be 0.8 multiplied by our previous day estimate of 0.208 plus 0.2 multiplied by our return squared. And that gives us 0.1709. And then we just keep repeating that for the remaining values. Finally, we have implied volatility. And implied volatility is the volatility that is solved for by setting the market price of an option equal to the model price. So we invert the options price formula and we find sigma, or our implied standard deviation, that equates the model price F to the market price. So suppose we have a call option price from the market. We set that equal to, for example, the Black-Scholes equation. And then we solve for what the sigma, or the implied standard deviation, is in the model, given this market price over here. Next, we'll cover Monte Carlo simulation acceleration methods. The first is antithetic variables. And this consists of changing the sign of all random samples epsilon and creates twice as many observations with little additional work. And it's appropriate when your original distribution is symmetric. So you start off generating random samples, and then you just flip the sign of them. If they're positive, they're now negative. If they're negative, they're now positive. And now you have double the sample, or double the number of random samples. The second technique is control variates. And here we assume that the simulated value of Vx can be approximated by another function, Vqx, which has a closed form solution. And we also note that Vqx and Vx have to be highly correlated. The control variate estimator is equal to Vx minus Vqx minus Vq. And this estimator has much lower variance than the original one. A common example would be when simulating option prices, we use the Black-Scholes model as our control variate. Next, we have importance sampling. This attempts to sample along the most important paths. So the goal is to measure a tail quantile with VAR. So there's no point in doing a simulation that will generate observations in the center of the distribution. We can substantially reduce the variance of the estimator if we focus on the tail. And finally, we have stratified sampling. Here we split the distribution of results into strata, and then we change the probability of each strata to put more probability weight on the region that we're interested in. So suppose we want a 90% VAR. Well, we can split the distribution into two strata, those less than 90% and those more than 90%. And then what we can do is we can change the probability of each region. So the first region, 0 to 90, we can assign a probability of 50%. And then 90 to 100, we can assign a probability of 50%. Then all we need to do is adjust the estimator to account for this adjusted probability. Next, we'll cover how to generate correlated random variables with the Cholesky factorization. So suppose we first start off with a set of independent random variables n, and we want to transform them into epsilon, which are correlated. We can use the Cholesky factorization to do this. It allows us to generate correlated variables with more than 2 dimensions. So suppose, here's some math, R is a symmetric real matrix, meaning that it can be decomposed into the following factors, T and T prime, where T is a lower triangular matrix, meaning that T has values along the diagonal and in the lower part of the matrix, and then it has zeros in the upper part of the matrix. And T prime would just be the opposite. It would have values in the upper right and then zeros in the lower right, or the lower left, I mean. Now, to perform a Cholesky factorization, we start off with a correlation matrix. And what we want to do is generate a matrix T and T prime such that T is a lower triangular matrix and T prime is an upper triangular matrix. So this is just some simple algebra. So we set our correlation matrix equal to this factor matrix A11, A12, A22, and then the transpose of that matrix. Then we multiply these two matrices together. So A11 multiplied by A11, 0 times 0 gives us A11 squared. A12 multiplied by A11 and A22 multiplied by 0 gives us this term, and so on for the other two terms. And then all we do is perform algebra. We take this matrix here, equate it to this matrix here, and solve for these A11, A12, and A22 terms. So we set A11 squared equal to 1, solve for A11 is equal to 1. Then we set A11, A12 equal to rho. We know that A11 is equal to 1, so A12 must be equal to rho. And then finally, A12 squared plus A22 squared should be equal to 1. So we know that A12 squared is rho. We can bring that over here and then take a square root, and we can show that A22 is equal to the square root of 1 minus rho squared. And the same concept can be applied to a 3 by 3 matrix. You create your lower triangular matrix and your upper triangular matrix, multiply the two of them together to get a 3 by 3 over here. You have a 3 by 3 correlation matrix, and then just solve for the factors. The final step is to actually generate the correlated random numbers. So what we do is we have a matrix N that is uncorrelated, and what we're going to do is pre-multiply that by our lower triangular matrix T, and that'll be equal to epsilon. So we take our triangular matrix that we just solved for here, 1 rho, square root of 1 minus rho squared, and 0, and we multiply it by our N1 and N2, which are uncorrelated. Then if we multiply these two matrices, we get 1 times N1, so we get N1 as our first term, and we get rho times N1, so rho times N1, plus the square root of 1 minus rho squared times N2 as our second term. So our matrix of correlated random variables is N1 and rho N1 plus the square root of 1 minus rho squared N2. Now we have equilibrium versus arbitrage-free models. Equilibrium models postulate a stochastic process for some factors, which generates a term structure, and this term structure will not exactly fit the observed market prices. So really all you need to know about equilibrium models is that they're a mathematically elegant solution, and that the prices that the model spits out won't match the market prices that are observed. Arbitrage-free models take the term structure or the market prices as input and then fit a stochastic process to those model prices so that when you run an arbitrage-free model, the prices will exactly match those that come out that are in the market because you use those as input in the first place. Next, we have the GEV, or a generalized extreme value distribution, and this models the distribution of extreme values, or block maximum. Now, the formula for the GEV distribution, or the CDF, is the formula right here. And I suggest you memorize this formula as well as the formula on the next page, which is the standard formula. And what you'll need to know is that alpha is the location parameter, beta is the scale parameter, and gamma is the shape parameter. Now, the important parameter in this is alpha. So if alpha is greater than 0, we have a Frechet type distribution. And here the tail follows a power law, where extreme values come from the student T, Pareto, or Levy distributions. And these distributions have heavier tails. If alpha is equal to 0, we have a Gumbel type distribution. So the tail is exponential. And an example would be the normal and gamma. And if alpha is less than 0, we have the Weibull type distribution. So the tail falls off so quickly that there's actually a finite endpoint. Think of the beta distribution, the uniform distribution, or the triangular distributions. And again, here we have the standard GEV distribution. Again, you'll want to memorize these formulas. The CDF is as follows, and the density is as follows. And you'll also want to know how to convert a CDF to density. And you'll also want to know the formulas for when gamma equals 0 and gamma is not equal to 0. So what are the drawbacks of the GEV? Well, it only uses the largest value or values in each block of data. So it ignores a lot of potentially useful information. So as a result, the GPD method is more commonly used. So what is the GPD? Well, it's the generalized Pareto distribution. So consider the probability that x minus mu is less than or equal to x, given that x is greater than or equal to u. So the probability that x minus u is less than x, given that we're greater than u already. Now what happens? Well, if observations are IID, then as the threshold u increases, the conditional loss distribution, no matter what the underlying distribution is, normal, gamma, anything, converges to the generalized Pareto distribution. Now, what you'll need to memorize is that the formula here for gamma is equal to 0 and not equal to 0. You'll need to know that gamma and beta are the shape and scale parameters, and that beta has to be greater than 0, and gamma can take any value. Another two formulas to memorize would be the standard generalized Pareto distribution, and it occurs if you set beta equal to 1. Again, know the CDF and the density, and how to convert the CDF into a density. And finally, we'll cover selecting the threshold U. So we know that as the U increases, the distribution converges to the GPD. But how do you select a U in practice? Well, one approach is to use the empirical mean excess function. Very fancy word for actually a simple concept. So the approach is to select a value of U by using the EU function here, where I in the function is an indicator function. Now, what you do is you put in different values of u, increasing u by small increments, and you evaluate the mean excess function. And what you're looking for is you're looking for the point at which the mean excess function starts to level off. And when that occurs, that would be a good choice for your u value in your formula. Next, we'll move on to interest rate risk, and we'll cover single factor interest rate models. Three single-factor models are the Ho-Lee model, the Vasicek model, and the Hall-White model. The Ho-Lee model models the interest rate as the change in R is equal to alpha t plus epsilon t. Now, model prices from this model do not correspond well with market prices. This is very similar to like a stochastic model for a stock price. The Vasicek model incorporates mean reversion into the equation. So we get the change in R is equal to alpha minus beta R t minus 1 delta t plus epsilon t. Now the speed of mean reversion, you'll want to memorize this. They can often give you an equation for a Vasicek model and then ask you what is the speed of mean reversion. And all you'll need to do is the speed of mean reversion is just alpha over beta. Now again, model prices do not fit market data perfectly with this model. Next, we have the Hall-White model, which is basically the Vasicek model, but it introduces a time-varying component for alpha. So it's alpha t, which varies by time. And then again, it has mean reversion right here. Next, we have the CIR model. Now, the Vasicek model allows negative interest rates. Now, in the past, you would say that's probably not possible, but there's actually some negative interest rates in the world right now. Think Germany. So we can modify, or assuming that we don't want negative interest rates though, we can modify the volatility so that is proportional to the square root of the previous value. So the CIR model, again, has a mean reversion term here with alpha and beta dependent on t. And then we have the square root of RT minus 1. And this term right here eliminates the negative interest rates that occur with the Vasicek model. And finally, we have the Black-Karaszinski model. So this avoids negative interest rates as well, but it utilizes the Vasicek model, but applied to the natural logarithm of interest rates instead of just RT. And next we have multi-factor models. So the one that I'll cover is the Brennan-Schwarz model. And this model is the short rate and the long rate. The short rate is equal to alpha plus beta times R2t minus 1, which is the long rate, minus R1t minus 1, which is the short rate, plus a factor that's linked to the short rate. And then the long rate has a component alpha plus beta times a component linked to the short rate and a component linked to the long rate. So this is a pretty complex model, but what you'll need to know is that The Brennan-Schwartz model models the short rate and long rate with two processes. Next, we'll move on to credit risk. There are three types of credit risk models: credit scoring models, structural models, and reduced form models. Credit scoring models use features of an entity to arrive at a score that gives a likelihood of insolvency. Think Probit or Logit models, Altman's z-score, k-nearest neighbor, and so on. Structural models model the value of an entity, but don't rely on accounting ratios. Think the Merton model, which is based off of the Black-Scholes model, or the KMV model. And finally, reduced form models, which use some other quantitative or qualitative approach. Probit or Logit models are a general linear model where the dependent variable can only take a value between 0 and 1, and it is usually used for modeling the probability of default. Discriminant analysis, an example would be Altman's z-score, gives each firm a score that indicates whether it is likely to become insolvent or not, and it utilizes financial ratios. A score above 2.99 is safe, whereas a score below 1.8 would indicate that they have some risk of distress. The problem with this is it relies on financial ratios, which can be skewed by management. Next, we have the Merton model, which considers the probability that a value of the assets will fall below some level B at time t, and is based off of the Black-Scholes model, n at negative d2. So suppose we have $500 of assets. The expected growth rate of assets is 10% per year, and the volatility is 30%. And assume that the firm has $300 in debt. We can calculate the probability of default by plugging those values into the negative d2 formula. So for this case, the firm would have about a 2.96% chance of defaulting over the next year. The KMV model uses an indirect route to find the probability of default. And the main feature from this model is the distance to default. And I've seen questions asked on this before. So the distance to default is just x0 minus beta hat over x0 sigma x. And this gives us the number of standard deviations the firm value is from default. And the KMV model derives x0 and sigma x from the firm's equity value in the market. And finally, we have credit migration models. Here, we utilize transition matrices to infer default probabilities, and most credit agencies produce these matrices. So suppose we want to calculate the probability of a current rated A bond defaulting over the next 2 years. Well, the probability that an A default or A bond defaults over 1 year would just be the default probability for A, or 0.08. Now in this case, we also have unrated bonds, so we need to divide by 1 minus the probability of being unrated. To calculate the probability over the second year, what we actually do is we say, okay, well, A can transition to AAA, can transition to AA, stay A, go to BBB, double B, or B, or CCC. And once it transitions to those other states, it can then default in that state. So it's kind of a probability of A moving to AAA, then defaulting, probability of A moving to AA, then defaulting, and so on. Then we just add up all these probabilities along with the first year probability, and that would give us the probability of defaulting over those 2 years. It's relatively simple. All you need to know is that it's a transition. You can go to each of these different states, and when you're in those states, you can then default. There are also 5 risk aggregation methodologies that you should be familiar with. The first is a simple summation, which you just sum the individual components and you ignore any possible diversification. The second is a fixed diversification percentage. So you sum the components and then you subtract out some fixed percentage multiplied by the total capital. The third is the common variance covariance matrix. Here you take the standalone risks and you multiply them by a correlation matrix. The fourth is a little bit more advanced. It's copulus. So here we deal with the issue by splitting the problem into 2 parts. So the first part describes the individual behavior of each risk on its own, or the marginal risk distribution. And the second part describes the dependency structure between the risks. And this is known as the copula. So the individual marginal risk distributions are linked together into a joint distribution using a copula. And finally, we have causal modeling, and this is the backbone to economic scenario generators. So the common risk drivers that impact risks are modeled, and the linkages between each risk are also modeled. So think inflation. Inflation is derived from a nominal yield curve and a real yield curve. Then interest rates also affect insurance losses. So if you model inflation, then you link them to nominal and real yields, which are linked to interest rates, which are linked to insurance losses. So you can think of it just as a series of cause and effect and links between different risk variables. And this model is often used with other methods like correlation matrices or copulas. Next up, we have real world versus risk neutral. This is a pretty important concept, so I'll try to describe it as well as I can. With real world, it's a method to calculate the present value of cash flows by discounting cash flows with risky discount rates. So here we have risky discount rates. We don't have risk-free discount rates. So we project the cash flows, and the cash flows are not adjusted. The discount rate is actually adjusted. So we set the discount rates higher than the risk-free rates to account for the risk. We use real world for calculating economic capital usually. Now, the real world is associated with the P measure. So the present value of future cash flows is based on the adequate discount rate and a real world probability distribution, or P measure. With the risk neutral scenario, it's a method to calculate the present value of cash flows by discounting risk adjusted cash flows. So we adjust the cash flows, not the risk-free rate or the rate, and then we discount at the risk-free rate. Now we use risk neutral for pricing derivatives or with stochastic scenarios. And the present value of future cash flows is based on the risk-free rate and a transformed probability distribution, or a Q measure. So the Q measure is associated with the risk neutral distribution. Finally, we have some formulas for the variance and covariance of our VAR and CTE estimate. I would definitely memorize these as well as the FSE formulas that are also on the exam. I've seen these come up in many different practice questions or previous exam questions. Next, we have Sklar's theorem. So for any joint distribution function f, there is a unique copula c that satisfies the following. So our joint distribution is equal to our copula function evaluated with our marginal functions as inputs. So here in typical math, we had a distribution function and then we put data points into it to get our probability. Or here we have a joint probability distribution and we have a copula function where we actually take probabilities as input, and what's output is a joint probability. So Sklar's theorem shows that we can separate the dependent structure from the marginal distributions. So we can construct a multivariate distribution from the marginal distribution functions and a copula. Another important concept from copulas is tail dependence. And tail dependence measures how strong the correlation is in the upper and lower tails. Here, an exam question might ask you to find the upper tail dependence or lower tail dependence for a copula. And I would memorize both of these formulas. It's basically a limit formula. And one hint is that you'll need to review L'Hopital's rule because often you'll need to apply that to solve these limits. Now we'll cover objective 3. We're going to go through this rather quickly. So the shortcomings of VAR. Well, shortcoming 1 is that VAR is not coherent. It fails subadditivity. Shortcoming number 2, VAR is really built for the normal distribution, but in reality, the normal distribution doesn't always apply. So that's a weakness for VAR. Shortcoming number 3, different companies use different methods to calculate VAR, and this makes it hard to compare one company's VAR to the next. Shortcoming number 4, well, VAR is often based off of historical data and an observation period. If that observation period or historical data doesn't contain all of the potential outcomes, then VAR will be underestimated. Shortcoming 5, agency problems. So VAR has weaknesses, and if a trader can exploit those weaknesses, they can take advantage of VAR. Think of credit default swaps. Here, you're selling a product for a small premium, and you're shoving risk way into the tail. So a VAR model would not pick up on that risk, but you're going to be able to generate all these premiums and returns. And that was kind of the problem with the financial collapse. One of the problems, I should say. And shortcoming number 6, regulatory issue or disclosure. So different regulations require different VAR estimates, and this gets a little bit confusing. As well, it's not clear whether you should use internal models in some cases, and it provides, again, a link to shortcoming number 3, where institutions utilize different methods. So can you really be sure about a company being secure and comparing regulations between companies when they're using different models? So some alternatives to VAR, well, we have the expected shortfall, or the CTE, the conditional VAR, the modified VAR, the co-VAR, and the stressed VAR. I would memorize each of these, and just a potential question would ask you to list alternatives to VAR. And important ones would be expected shortfall, obviously, and maybe conditional VAR. Next, we have coherence, and there's 4 axioms: subadditivity, monotonicity, positive homogeneity, and translation invariance. Definitely memorize these because they've previously come up a lot on different exams. One thing that I always like to do before the exam is memorize an example of showing how VAR fails subadditivity and how variance or standard deviation fails monotonicity. And I've shown a quick example here that you can memorize. So first, you provide values for x1 and x2, and you put 1 as the loss in scenario 10 and 1 as the loss in scenario 9. Then the loss for x1 plus x2 would be 1 in 9 and 1 in 10. Then all you do is you order each of these losses. So 0 through 1, 0 to 1, 0 to 1, and 1. And then you say that, what is the 85% VAR? Well, the 85% VAR for x1 and x2 is 0, but the 85% VAR of the combined is 1. So now we've shown that the risk of x1 plus x2 is 1, which is greater than the individual risks combined, which shows that VAR fails subadditivity. So this is a very simple example that you could quickly spit out on the exam to show how VAR fails subadditivity. We're running a bit short on time, so I'll actually just skip some of these topics here, and we'll move on to key rate durations, because I think this is pretty important. So effective duration is the ratio between the proportionate change in the security value to a small parallel shift in the spot curve. Effective duration should be fairly common and fairly easy for you to understand. The new concept here is key rate durations, which are a vector representing the price sensitivity of a security to each key rate change. And the sum of our key rate durations is equal to our effective duration. One thing that they might ask, or a typical question, especially with the case study, is to identify any interest rate bets that a portfolio has. So to do this, what you do is you sum each of the key rate durations and you get the effective duration. Then you take the effective duration divided by the number of KRDs to get the average KRD. Then you take each KRD divided by the average KRD to get a ratio. And any rates that have a ratio greater than 1 indicate that the portfolio is taking a bet on those KRDs. Another example of a KRD type question that might come up, well, suppose you have some sort of bond, say a $50 million bond, and you want to find a replicating portfolio that hedges this bond to interest rate changes. Well, what you do in this process is, say you have 5 KRDs. What you do is you use the formula bond value multiplied by KRD divided by time, and that gives you the amount to invest in each of the times. Here we have 5 times, so at time 0.25, you take 50 times the KRD divided by 0.25, so you'd invest 4 at time 0.25, 9.5 at time 1, and so on. Then you sum these amounts, and you get the total, say 38.48. Then you have to figure out how much to hold in cash. So you take the amount of your bond minus the sum of your calculated values above. In this case, it's 11. So here you would hold 11.51 in cash. But in other times, say this was 30, for example, well, you'd get a negative number here. Well, if you get a negative number here, you have to borrow that amount in cash. Finally, we have reinsurance. So reinsurance is a financial transaction where risk is transferred from the insurer, or the ceded, to the reinsurance company or the reinsurer in exchange for a reinsurance premium. So you have an insured who buys insurance from the insurer, who then buys insurance or reinsurance from the reinsurer. And then the reinsurer can actually buy insurance on itself from retrocessionaires. Now, this differs from co-insurance, where you have multiple insurers insuring the same risk. You can see here each insurer is sharing in this risk, whereas in this reinsurance chain, the reinsurers insuring the insurer, and the insurers insuring the insured, and so on. So what is reinsurance used for? It's used for increasing underwriting capacity, risk capital improvement and diversification, surplus relief, catastrophe protection, expertise transfer, and financing new business. And there are two types of reinsurance agreements: automatic treaty and a facultative treaty. An automatic treaty, what happens here is all risks are defined in the agreement, and then they're automatically ceded to the reinsurer, and the reinsurer has to accept the risks. In a facultative agreement, the insurer decides which risks will be offered to the reinsurer, and then the reinsurer decides on an individual basis if they'll accept that risk. And then there are two forms of reinsurance: proportional and non-proportional. Finally, we have Objective 5. First, we'll cover Basel II. This is an international standard for banks, but Basel III does now exist, so you may want to look into Basel III. Basel II utilizes three pillars. It specifies the minimum capital amount, it has a supervisory review, and a market discipline component. And the three major components of risk are credit risk, operational risk, and market risk. Solvency II is also based on a three-pillar approach. The first is, again, a quantitative requirement. Here, though, there are two capital requirements: the solvency capital requirement, or SCR, and the minimum capital requirement. And the SCR can be calculated either with a standard formula or an internal model. The second pillar, again, is a qualitative requirement, and it dictates the risk management standards and supervisory activities. And finally, Pillar 3 is supervisory reporting and disclosure. Coming back to ORSA, again, own risk and solvency assessment, it's intended to be the insurer's own view of its risks and solvency position. So the regulator doesn't specify what the insurer needs to do. The insurer actually has to come up with its own view of risk. And the insurer has the freedom to decide the best way to assess its risk and calculates capital required. And this ensures that risk management, capital planning, and strategic planning are all linked. In my own personal job, I often deal with ORSA all the time, and what we do in Canada is we actually set the required capital for the company based on our own view of the risks that the company is exposed to. And then we compare that to the required capital in Canada, we use the MCCSR requirements. Another common concept for the exam is the 3 lines of defense approach. I would memorize this as well. The first line are your business units, your day-to-day people. The second line are your control functions, like your risk management department, your compliance, or your actuarial oversight function. And the third line is your internal audit function, which is an independent review and assurance of the results. And the final concept we'll cover today is risk-based capital, which is the capital standard for the US. And it's developed by the NAIC and provides capital adequacy standard for insurers. There's a separate RBC formula for life, P&C, and health. And it utilizes a generic formula approach, not a modeling approach. Although for RBC Life, there is a modeling approach used for interest rate risk. So how it works, you take an amount from the financial statement and you apply a factor to calculate the RBC risk charge. And a separate RBC risk charge is calculated for each individual risk. And the RBC system has 2 components. The first is your risk-based capital formula, which establishes the minimum capital level. And the second is the risk-based capital model law, which grants automatic authority to the state insurance regulator to take specific actions based on the level of impairment. Basically, what this means is that if your level of capital drops below a certain point, the state regulator can actually step in and take control of the company to ensure that or find a way to get the capital above that minimum level that is needed. The risks, well, for life, P&C, and health, there are different risks. Some common risks between the 3 are asset risk and different types of insurance risk. For RBC Life, we have C2 risk or insurance risk. For the P&C branch, we have underwriting risk for reserves and net written premium. And for health, we have underwriting risk. And then there's interest rate risk for life and business risk. For P&C, we have many different asset risk components. And for the health, we introduce credit risk as well as we have business risk. The formulas, I won't go over them in detail, but what you need to know about them is this square root term in each of the formulas. What this does is it actually introduces a little bit of a diversification benefit into the formula. So you take the squares of all these individual capital components, and the square root actually reduces the capital a little bit and provides a little bit of diversification. So that concludes the webinar for today. I hope that you've learned quite a bit, and I hope that it's provided an overall overview of the entire syllabus. And as a bonus, remember I'm sending out 100 practice questions for you as an added bonus for you for free. It'll give you a little extra practice. If you want more practice, we have our crunch time products out right now. You can buy our practice exams for $100, our practice questions, which gives you 900 plus practice questions for $100. I mean, that's cheaper than, a night out for some people. Or you can buy our case study and case study analysis for $60. And all of this is available at xpactuarial.com. Again, thanks for joining in, and I hope you've learned a lot, and good luck with the exam. You've got little over 2 weeks, and I hope you work hard and get through it. And remember, the time that you put in right now is going to be a heck of a lot better than the time that you wish you put in come the day after the exam. Thanks, and good luck studying.